You tap buy, and your order fills instantly. Who took the other side, and why were they waiting there for you? 100 shares blink into your account. The price is even a hair better than what you saw a second ago. That is not luck. Someone planned to stand there. They posted standing quotes to buy and sell all day. They get paid a tiny amount to give you speed. Let's strip it back and see how that works. The best bid is just the highest standing buy price. The best offer is the lowest standing sell price. The small gap between them is the bid-ask spread. Think of it as a convenience fee for instant action. You pay a little to get done now. The NBBO is the best bid and offer across all the places where a stock trades. It updates many times a second. Your broker tries to route you to that best pair. Why does a spread exist at all? Because the person who fills you takes risk. If they buy from you, they now own stock that can drop. If they sell to you, they can get squeezed if it jumps. Sometimes the person hitting them knows more than they do. That is adverse selection. Also, the gear is not free. Data, networks, and exchange fees all cost money. The spread pays for that bundle of risk and cost. So how do they actually make money? 4 small streams add up. First, they capture a sliver of the spread when trades cross the gap. Second, they can earn exchange rebates for posting quotes that others hit. We are talking about 2 to 3/10 of a cent per share. Third, they internalize retail orders and often give a tiny price improvement. Payment for order flow often runs around 1 to 3/10 of a cent per share. Fourth, they hedge smartly to lower risk. Here is the surprise. The spread is not pure profit. A big slice pays for bad fills, hedges, and that tech race to update quotes in microseconds. Scale is the trick. Virtu's filing in 2014 said it had only one losing day over more than 1,200 days from 2009 to 2013. That is not magic. It is thousands of tiny edges across many tickers. They do not try to be right on direction. They try to avoid being wrong for long. Close out risk, rebalance, repeat. It is boring by design, which is why it works. Decimalization changed the math overnight. In 2001, the market moved from fractions to decimals. The minimum tick dropped from 1/16, which is 6.25 cents, to 1 cent. Spreads in active names collapsed to 1 or 2 cents. That cut the small order cost by more than half right away. Trading got cheaper for you. It also squeezed the juice for dealers. To survive, they needed speed, smarts, and volume. Quoting is not just a hobby. On the New York Stock Exchange, designated market makers have duties. On Nasdaq, registered market makers have duties too. They must keep two-sided quotes during regular hours and help with auctions. Nasdaq's rules push high time at quote levels. In practice, many aim for around 90% or more. Miss too often and you face penalties. You can even lose the badge. Speed pressure has history. After the 1987 crash, Nasdaq's small order system forced auto-execution at displayed quotes for small trades. Fast day traders pounced on slow updates. People called them SOES bandits. Dealers learned a hard lesson. If your quote is stale, someone will take it. That pain pushed firms to invest in faster pipes and tighter controls. It was an early step toward today's electronic world. Where does your retail order really go? Many never touch an exchange first. Your broker often sends it to a wholesaler like Citadel Securities or Virtu. They fill you against their own quotes. They can give you a tiny sub-penny improvement that you cannot post on an exchange. Picture buying Apple at 195.011, while the offer shows 195.02. They hedge the risk in milliseconds in the lit market. A huge slice of trading also happens off-exchange. On some days, it has topped 40% of U.S. equity volume. That includes wholesalers and dark pools. Big funds working a 100,000 share order slice it into tiny parts. They move across many venues, while market makers and algos compete to take the other side. At the open and the close, auctions pull in volume. The DMM on the floor helps set one clearing price. That keeps those moments from getting messy. Maker-taker fees are the pennies in the plumbing. Exchanges pay you a small rebate to add liquidity. They charge you to remove it. We are back to about 2 to 3 tenths of a cent per share. Market makers route to places where the mix of spread and fees makes sense. One venue pays more, another has faster fills, another matches big blocks. It all adds up across millions of shares. Risk never sleeps, so firms cap their inventory. If they are long too much, they tilt their quotes to attract sellers. If they are short, they shade to attract buyers. When volatility jumps, quotes widen. That extra width covers price uncertainty and information gaps. They would rather hold thousands of tiny positions for minutes than one big bet all day. It is about turning the wheel, not swinging for the fences. On May 6, 2010, the wheel came off. Spreads blew out from pennies to dollars in minutes. Liquidity vanished. Many market makers widened hard or stepped back. About $1 trillion in value disappeared on screens, then snapped back. More than 20,000 trades were later canceled as clearly wrong. The lesson is blunt. Liquidity is a choice. When risk explodes, suppliers back away or raise the price a lot. March 2020 was a slower burn, but it rhymed. During the COVID shock, even giant stocks had fatter spreads and thin depth. Quotes stayed up, but with bigger cushions. Fair value was a moving target. Investors felt worse fills at the exact moment they wanted to trade the most. The price of instant action went up because uncertainty went up. That is how this machine protects itself. Payment for order flow and subpennies sit under different rulebooks by country. In the U.S., wholesalers can give you subpenny improvement on internal trades. It is legal with disclosures. In the U.K., paying brokers for flow has been effectively banned since 2012 because of conflicts. Same goals on paper, best execution for the customer. Different paths and different incentives by place. Here is the pattern that repeats. Competition crushes spreads in calm times. Risk blows them out in storms. Market makers earn many tiny edges on quiet days. Then you get a few scary days where they reprice or step back. The spread is the insurance premium for getting in or out right now. When fear rises, that premium rises with it. So what does this tell us? Markets feel liquid because someone gets paid to be brave in small doses all day. The person across from you is not guessing. They are running a machine for tiny, repeatable edges. Not every trade is with a market maker. Auctions match investors directly. Dark venues cross size. Off-exchange shares move around. Rules and numbers vary by venue and time. None of this is advice. It is the wiring behind the screen. If you are enjoying clear market mechanics like this, drop a quick subscribe. It tells us to make more of them. Liquidity in ETFs brings this home. The basket may be sleepy, but the wrapper feels smooth. That is often a market maker and an authorized participant making a bridge. They trade the ETF, they hedge with futures or the basket. They keep the gap tight so you can move in and out. Again, tiny edges. Again, scale. One more detail on price improvement. You sometimes see a fill at a better price than the national offer or bid. That is because a wholesaler can execute inside the penny for a retail order. You cannot post that yourself on the exchange because of tick rules. So the wholesaler uses that room to split a cent. You get a better price. They still have a sliver to earn after fees and hedges. Auctions at the open and close are special moments. The DMM, or the auction engine, gathers all the interest. It sets one price that clears the imbalance. That concentrates liquidity. It gives a clean print for index funds and end-of-day rebalances. Market makers join that process too. They help absorb temporary waves and keep the print orderly. Rules like Nasdaq 4613 sound dry, but they shape behavior. If you must keep two-sided quotes most of the day, you build systems to survive the grind. You cap risk. You widen when needed. You race to update in microseconds. You care about tenths of a cent in fees. Because over 1 million shares, tenths of a cent turn into real money. History shows why quotes are faster and tighter now. SOES bandits in the 90s punished stale quotes. Decimalization in 2001 cut ticks to a cent and squeezed spreads. Then rebates pushed everyone to compete on posting the best price. The result is a market that feels instant in normal times. Under stress, it reminds you that nothing is free. Let's ground this in a simple trade. You buy 100 shares of Apple at 10:17 in the morning. Your fill comes back at 195.011. The quote you saw was 195.02. A wholesaler took the other side. They gave you a tiny improvement. They hedged in the lit market in a blink. They kept a sliver after paying your broker for the order and after fees. Those pennies across 4 streams are not static. Sometimes the spread carry is thin, then the rebates matter more. Sometimes volatility jumps, then hedging costs more, and they widen quotes. Sometimes retail flow is heavy, then the internal fills rise. It is a portfolio of small engines. Each one spins at a different speed each day. Inventory control is constant. If a firm is long too much stock, it will nudge its quotes down to attract sellers. If short, it will nudge up to attract buyers. It is like tilting a table so marbles roll where you want them. The goal is not to predict the next 5% move. It is to avoid getting stuck holding a bag when the music stops. Off-exchange share is not a villain by itself. It can lower market impact for big orders. It can give you a better price on a small trade. The trade-off is less visible depth on exchanges. So the top of book can look thinner even if total liquidity is fine. Auctions help pull it together at key moments. It is a plumbing choice with pros and cons. A word on adverse selection. Sometimes the person hitting your quote has better information. Maybe they see futures move first. Maybe they are faster. Market makers price that in. They keep spreads just wide enough to cover those hits over time. If hits get too toxic, they widen more. If flow is gentle, they tighten. It is a living thing, always adjusting. This is why crashes feel fast and rallies feel slow. Fear makes people demand instant exits. That means they cross the spread over and over. Spreads widen as risk rises. Down moves cascade. When calm returns, spreads shrink. Then, prices grind higher with fewer urgent crosses. The tape shows human mood in the size of a penny. You do not need to trade like a market maker to learn from them. Notice when spreads are tight and depth is firm. Notice when they are not. Know that the price of speed moves with risk. That alone keeps you from asking the market to do the one thing it hates, which is to hand you size in a storm for free. One last caveat, numbers move. Off-exchange share bounces around day by day, rebate rates change by venue, quoting duties differ by exchange and product, retail rules are a maze. Treat the figures here as ballpark. The mechanism is the point. Someone posts prices, takes risk for a fee, and manages it in real time. The punchline is simple. Markets are liquid because someone is paid to be brave, in tiny bites, all day. The spread is the bill for that service. It shrinks when the sea is calm. It widens when the storm hits. If this kind of clear, no-hype market mechanics is your thing, subscribe and poke around the channel. Plenty more on bubbles, crashes, and the pipes that move prices. See you next time.